Stocks have beaten real estate by 5 times over the last 100 years. It's not even close. And yet homeowners somehow end up with 38 times more net worth than renters. Read that again. 5 times worse asset, 38 times richer owners. That math shouldn't work, but it does every single year in every single data set. And the reason it works is the dumbest, simplest thing you've ever heard. It's not the asset. It's not the market. It's not even the timing. It's something both your realtor and your stockbroker have a financial interest in never telling you, because the second you understand it, you stop needing either of them. My name is Nick, and today we're breaking down exactly which one will actually make you richer, why almost everyone gets this question wrong, and the one factor that decides the whole thing, which has nothing to do with the asset you pick. Stay with me. Leave a like, and let's get into it. Let me show you the number that started this whole debate. Over the last 100 years, the S&P 500 has returned about 10.4% per year on average with dividends reinvested. Adjusted for inflation, that's roughly 7.3% in real terms. U.S. home prices measured by the Case-Shiller Index returned about 4% nominal and somewhere between 0.3 and 1% real over that same century. Yes, real, annual return. On housing, less than 1%. Now, what does that mean in dollars? If you took $100,000 and parked it in the S&P 500 for 30 years at the historical average, you'd end up with about $1.74 million. If you took the same $100,000 and parked it in raw home appreciation, ignoring everything else, you'd end up with about $324,000. That's a 5.4 times difference. It's not even close. Stocks don't win this race, they lap it. So we should all be selling our houses and shoving the cash into index funds, right? Wrong. And this is where it gets interesting because real estate has a cheat code that stocks don't. It's called leverage. When you buy 100,000 of Apple stock, you put up 100,000 of your own money. When you buy a 500,000 house, you put up 100,000 and the bank gives you the other 400. Suddenly you control 5 times more asset than your cash should allow. And every dollar that house appreciates flows back to your tiny down payment. Here's the math that breaks people's brains. A 400,000 house with 80,000 down. If the house goes up just 3% in a year, that's 12,000 of appreciation on your 80,000. That's a 15% return on your cash from a 3% move in the asset. Add in the principal you pay down on the mortgage, around $3,600 in year one, and you're looking at roughly 17.6% return from a house that barely beat inflation. If the house goes up 5%, your cash on cash return is closer to 27%. That's better than the stock market in almost every year on record. This is the reason your dad keeps telling you houses are the only real investment, because mathematically, when leverage is working in your favor, nothing on earth touches it. And there's always a but in finance because finance is mostly buts. Leverage is a switch, and before I tell you what happens when that switch flips the wrong way, you need to see what it actually looked like the last time it did. The S&P 500 dropped 56.8% from peak to trough in the 2008 crash. That's brutal, but it recovered fully by March of 2013, including dividends, 5.5 years from disaster to new highs. If you held on, you came out fine. U.S. housing prices dropped 27.4% on the Case-Shiller National Index. Half as bad on the surface, but the full nominal recovery didn't happen until late 2016. And in real terms, adjusted for inflation, housing didn't make a new high until May of 2022. 16 years to recover from a crash less than half as severe as the stock markets. In Las Vegas, prices fell 55%. Phoenix, 51, Miami, 47. People who bought in those markets in 2006 didn't break even until their kids were in middle school. Now apply leverage to that. 80,000 down on a 400,000 house. If that house drops 20%, the house is worth 320. He owes 320, wiped out, zero equity, and he can't sell because there's no money to pay the realtor. The market made him rich on the way up and made him a prisoner on the way down. Stocks don't do this to you. If you own 100,000 in index funds and the market drops 30%, You have 70,000. You're sad, but you're free. You can sell tomorrow. You can move tomorrow. The asset doesn't own you. So why does anyone use leverage at all? Because most of the time, prices go up. And when they do, you're the one holding the bag of gold. Okay? I know this is a lot of numbers. Stick with me because we haven't even talked about the costs yet. And the costs are where this whole conversation gets weird. When somebody